So I wanted to talk to you about the American tax system. It's a topic I return to, but that many of you have asked me to talk about. We have a very complicated tax system, actually more complicated than in most countries, because we have three levels of government that all tax us, and they all do it differently. The federal, the state, and what we call municipal or local. They're radically different. So bear with me, but if you stay with me, you'll understand this, and you'll have it in your head for the rest of your life, and it will help you understand what's going on. First, the federal. The basic way the federal government raises money is a tax on income. In other words, when you earn something, one way or another, the government comes in and takes a piece. That's how the federal government pays for itself. That is not the way state governments mostly do, and it is not the way local governments do. They do other things. We're going to do that in a few minutes. But the federal government has two kinds of income tax. It taxes the income of individuals, like you and me, and it taxes the income of corporations, the profits. That's called a corporate income tax versus an individual income tax. The individual income tax now raises roughly half of the total amount of money that the federal government raises. It is a progressive tax. The higher your income, the higher the percentage of your income that you have to pay. But less than half of the federal government comes off of a progressive income tax. The next big chunk, almost as big as the individual income tax that's progressive, is what's called the payroll tax. That's the money pulled out of your check every week if you get paid for Social Security and all of that. That is a different kind of tax. It is not progressive. What does that mean? The payroll tax is a flat rate. You pay exactly the same whether you earn $5,000 a year all the way up to $120,000 a year. Same percentage. It doesn't go up as your income does. Could it? Of course. That would just take a vote in the Congress, which is how you created the individual income tax. For those of you that are concerned, I've checked. Neither in the Bible, nor the Quran, nor any other holy book is it indicated what the tax rates should be. That is a human decision made by whoever the authorities are. So the payroll tax is a flat rate, but it isn't really flat because, and this is really wonderful, at about 100, I think it's right now 118,000, something very close to that. You pay the same rate whether you earn 5,000, 50,000, all the way up to 118. But on every dollar you earn above 118, your payroll tax wonderfully goes to zero. If you're very rich, you pay a lower percentage for payroll because every dollar you earn above 118 is completely exempt of the payroll tax. Do you understand? This is a tax organized to help rich people. You get to pay it, they don't have to. I mean, they pay on the first 118 like we all do. But since they earn a lot more than that, the bulk of what they earn, they don't have to pay the payroll. That's not progressive. That's what we call regressive. That's not good. Or rather, it's good for them. That's the federal government. The rest of what the federal government gets is a corporate income tax. That is very, very low. That used to be high, but the companies have been very successful to lower it. So that brings in something on the order of 8 or 9% of the government's revenue comes from corporations. About 85% comes from you. So on behalf of the corporations and the rich, I want to say to all of you, thank you. Very, very kind of you to do this. Because, of course, if you didn't allow this, it would stop. Because you're the majority, and you're a large number of people, and the ones at the other end are a small number of people, and they are afraid of you. Which they have reason to be, unless, of course, you aren't going to do anything about this. In which case, they got nothing to worry about. That's the federal government. Is there any other source of income? They're trivial. The federal government levies a tax on alcohol. It levies a tax on motor fuels. These are called excise taxes, but they don't bring in a significant amount. So let's now move to the states. Completely separate story. They also raise money because they do things that the federal government doesn't. For example, the federal government doesn't run universities. States do. The federal government only maintains the federal roads, the interstates, but all the other roads are responsibility of the state. and on and on and on. So it's a whole complicated system in which the state has responsibilities that it has to raise money for that the federal government doesn't. The federal government, for example, has to pay for sending missiles to Syria. Ohio doesn't do that. So where do the states get the money? Well, they use a variety of things. Some states, not all, have an income tax. So that means, like in New York, you get to pay an income tax to the federal government, and in addition, an income tax to the state government. In fact, if you live in New York City, you get this enjoyment 3 times, because the city of New York also has an income tax, so you get to pay a federal and the state and the city income tax. You lucky people. But that's not the major way the state raises money, and it's not the way most states raise money. They mostly use something called a sales tax. That's that little addition when you buy a blouse or something and you see the prices, $40, but then you pay more at the cash register because they slap on it the sales tax that local store has to collect and send to the government. That's where the money for most states come in. Dog licenses, car licenses and registration, they had that. And that's not nothing, but the big thing is a sales tax. So let me tell you about the sales tax, because you'll notice it has something in common with the payroll tax. A sales tax makes no effort to discriminate according to your ability to pay. A progressive income tax does that. The higher your pay, the bigger the percentage. The idea being those who have more should be asked to contribute more to the common fund that takes care of all of us. Not a complex idea. But a sales tax doesn't do that. A sales tax is X% on the price of the object. It doesn't distinguish whether you buy that object at TJ Maxx or Rockefeller walks into TJ Maxx. I'm granted he wouldn't do that, but if Rockefeller went in and bought the same shirt you did, Rockefeller would pay the same tax you did, and therefore as a percentage of his ability to pay, it's nothing. That's a very good tax for rich people. Why? Because for them, these are trivial amounts as a percentage of their income or their wealth. But even more, the richer you are, the bigger the portion of your income you don't spend. You save it. And if you save it, it's not subject to a sales tax. A sales tax only hits you when you spend money. And the poorer you are, the more likely you are to have to spend everything you get. So they get you. Now, if you're an American, they get you on your income tax. And with what's left, you can go and buy stuff, and they get you in the sales tax. So when you hear someone say, hey, it's not fair, I'm being double taxed, you now understand something. Everybody is double and triple and quadruple taxed. You hear someone say, I shouldn't be double taxed, that person is counting on you not understanding how the tax system works. Sales tax is the big thing, and that's a regressive tax. It discriminates against middle and low income people and is the best possible way for wealthy people to have a tax system because they escape much of it. Now let's go down to the third level, local, municipal. First, to make sure, what does a local municipal government do? It does things the federal government and the state governments don't. For example, your public schools are handled as a local responsibility. So is the fire department. So is the police department. And so there's a whole bunch of local things. And how is the money raised to pay the teachers, build the schools, pay the cops and the fire and all the rest? They don't use an income tax. Most cities and towns don't. They don't use an income tax very much, very rare. They don't use sales tax, very rare. Some do, but very rare. Well, how do the locals do it? It's a property tax. This is wonderful, folks. You're gonna love this one. Every city and town has something called the tax assessor. What the job of the tax assessor is to assess, to determine the value of all the property, all the taxable property in the town. The land, the buildings, the automobiles, the boats, things like that. They put a value on it. They actually send a person to your house, your business, who measure the square footage and they come up with an estimate. They figure out the value of the property and they hit you with a tax each year on that value. If you own land, you got to pay tax on the value of the land. If you own a building, you pay a tax on the value of the building, and so on. That's how local communities get it, the value of it. It's a flat rate. There we go again. There's no attempt to make ability to pay count. No attempt to do what only the federal income tax does, progressive. But here comes the best part. What counts as property for a property tax? You might think it's all the property. And the answer is, You count the land, you count the buildings, your home, you count the store buildings, you count the cars. Everybody has to pay on that. But here's a kind of property that is not taxed in the United States by anybody. Stocks and bonds. Let me do that again so you're real clear with me. You sell a $100,000 house. On that house, in that town, you've had to pay property tax for as long as you own the house. If you sell the house, $100,000 house, and you get $100,000 cash and you buy $100,000 worth of General Motors stock or anything like it, your tax goes from whatever it was when you had the house to nada, zilch, nothing. So the property tax is wrongly named. It is a selective property tax. It's on some kinds of property, but not on others. And here's the important news. 1% of share owners own 2/3 of all the shares. So the 1% don't have to pay because most of their property is not in land and buildings, it's in stocks and bonds. If in the United States the owners of stocks and bonds were required to pay a property tax at the same rate that you pay on your car or your home or your empty lot, the amount of money coming to cities and states could transform your life. You'd have the best parks, the best schools imaginable. But we don't do that. We say to people, if you're rich enough to have stocks and bonds, you don't pay any property tax at all. You don't pay to the local town where you live, you don't pay to the state, and you don't pay to the federal government. You do have to pay on the income your stocks and bonds earn you. If you earn dividends or interest, that's part of your income. But that's like having a house. If you rent out an apartment in your house, you have to pay income tax on the rent on top of the property tax you pay on the value of the home. But if you own stocks and bonds, you have to pay tax on the income they generate, but no tax on the value of the property. That is a stone-cold ripoff of which you are the victim, because the government you count on hasn't got the revenue, because those rich enough to have sizable stocks of bonds and stocks are not having to pay anything. And that's legal. That's the way the law has been written by them, of course. Therefore, you live in a tax system that is as unjust as I could imagine, cleverly pieced together so that the little bit of progressivity of the federal individual income tax is completely swamped by the non-progressivity, the regressivity of the rest of the tax structure. Any discussion of tax reform that doesn't deal with these fundamental injustices isn't worthy of the name. Mr. Trump's tax reform never touched on any of this.